I need you to pay very close attention to what I'm about to show you, because what just happened in the gold market has only occurred 3 times in the last 20 years, and each time, gold exploded higher within weeks. I'm talking about the Commitment of Traders report, and if you understand what this data is telling us right now, you'll realize we're sitting at the edge of one of the most significant gold moves in modern history. Let me start by explaining what the COT report actually is, because most people have heard of it but don't really understand the power of this data. Every Friday, the Commodity Futures Trading Commission releases a report that shows exactly who's buying and who's selling in the futures markets. We're not talking about retail investors or small traders. We're talking about the big players, the commercial banks, the hedge funds, the institutions that move billions of dollars with a single trade. This report pulls back the curtain and shows us their exact positions. And right now, what they're doing is absolutely stunning. Here's what makes this so critical. The commercial traders, these are the big banks like JP Morgan, HSBC, Goldman Sachs. They typically hedge their physical gold positions in the futures market. When they're heavily short, it usually means they're confident gold is going down, or at least staying flat. But when they start covering those shorts and flipping to the long side, that's when you need to pay attention. And that's exactly what's happening right now, on a scale we haven't seen since 2018, right before gold ran from $1,400 to over $2,000. The latest COT report shows commercial traders have reduced their net short position to the lowest level in 7 years. Let me put that in perspective. 7 years ago, gold was trading around $1,200 an ounce. Today we're at $2,600. And the commercials are more bullish now than they were back then. These aren't amateur traders making emotional decisions. These are the smartest money managers in the world. The ones with access to data and analysis that you and I will never see. And they're positioning for a massive move higher. But here's where it gets even more interesting. At the same time the commercials are covering shorts, the large speculators, the hedge funds and managed money, they're actually reducing their long positions. This is the exact opposite of what you'd expect at a market top. Usually when gold is about to crash, you see hedge funds piled into long positions, while commercials are massively short. Right now we have the inverse. The smart money is bullish, the dumb money is cautious, and that divergence is one of the most reliable buy signals in the entire commodities complex. I want to take you back to 2018 because the parallels are almost eerie. In August of that year, the COT report showed a similar setup. Commercials had covered their shorts down to multi-year lows, speculators were underweight, and everyone was calling for gold to break down below $1,200. The mainstream financial media was writing obituaries for gold. I remember reading articles with headlines like, "Gold's bull market is dead," and "Why gold will never see 1,500 again." And then what happened? Gold bottomed at $1,160 that month and proceeded to rally 75% over the next 2 years, hitting an all-time high above 2,100. The people who understood the COT data made fortunes during that move. While everyone else was selling in fear, they were accumulating. And here's the thing. The setup today is even more bullish than it was back then, because we have additional factors that didn't exist in 2018. We have central banks buying gold at the fastest pace in 50 years. We have BRICS nations actively working to create a gold-backed trade settlement system. We have the U.S. national debt spiraling completely out of control. We have geopolitical tensions at levels not seen since the Cold War. The COT report is telling us the smart money sees all of this, and they're positioning accordingly. Let me break down the actual numbers because this is where it gets really fascinating. As of the most recent report, commercial traders hold a net short position of just 42,000 contracts. To put that in context, at the peak of their bearishness in 2019, they were short over 300,000 contracts. They've covered 86% of their short position. That's not a minor adjustment, that's a complete repositioning. And every time they cover a short contract, they're buying gold, which puts upward pressure on the price. Meanwhile, the managed money category, which includes hedge funds and CTAs, they're holding a net long position of just 98,000 contracts. Back in 2020, when gold hit its previous all-time high, they were long over 350,000 contracts. So we have massive room for these speculators to pile back in. When they do, and they will once gold breaks through key resistance levels, we're going to see the kind of explosive move that catches everyone off guard. Now I know what some of you are thinking. You're thinking, okay, but gold is already at all-time highs. Isn't it too late to get in? And that's exactly the kind of thinking that causes people to miss the biggest moves. Gold hit a new all-time high in October, yes, but it's barely broken out. We're talking about a 3% move above the previous high. That's nothing. When gold really gets going, we're talking about 20, 30, 40% moves in a matter of months. The COT data is telling us we're at the very beginning of this move, not the end. Think about what happened in 1979 and 1980. Gold had been in a bull market for years. It had already gone from $35 to $500, and everyone thought it was overvalued. Then, in the final 18 months of that bull market, it went from 500 to 850, a 70% gain in less than 2 years. The people who said, "It's too late," at 500, missed the biggest part of the entire move. The COT report back then, if we'd had it in its current form, would have shown the exact same setup we're seeing today. Here's another critical piece of this puzzle. The COT report doesn't just show us positioning, it shows us conviction. When commercials are heavily short, they're willing to take massive losses if they're wrong. They're putting billions of dollars on the line. The fact that they've covered those shorts tells us they're no longer willing to bet against gold. They've essentially admitted defeat on the short side. And these are not people who admit defeat easily. These are the same institutions that manipulated the gold market for decades, that got caught and fined for spoofing and price suppression. If they're backing off, it's because they know something big is coming. Let me tell you about what's happening in the physical market, because this ties directly into the COT data. The COMEX, which is where these futures contracts trade, is seeing a massive drain of physical gold. In the last 6 months, over 4 million ounces have been withdrawn from COMEX vaults. That's 125 tons of gold leaving the exchange. When physical gold leaves the COMEX, it means someone is standing for delivery. They're taking the actual metal instead of just rolling their futures contracts. This is exactly what happened in the lead-up to the 2011 gold spike, when gold went from 1,500 to 1,900 in a matter of weeks. The commercials see this physical demand, and they know what it means. It means the paper market is losing control. For years, the price of gold has been set by paper contracts, by futures and derivatives that have no actual gold backing them. But when physical demand overwhelms the paper market, the price has to adjust to reality. And reality is that there's not enough gold to satisfy demand at current prices. The COT report is showing us that the commercials understand this, and they're getting out of the way. Now, let's talk about what this means for you personally, because this isn't just about making money on a trade. This is about protecting your wealth in an environment where everything else is at risk. If you're sitting on retirement accounts, if you have savings in dollars, if you're worried about inflation and currency debasement, the COT report is giving you a clear signal that gold is about to become a lot more valuable relative to paper assets. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers exactly how to get physical gold into your retirement account without triggering tax penalties, how to choose a custodian, what the fees look like, all of that. This is something I wish I'd known about years ago because it would have saved me a lot of headaches. Worth checking out if that's relevant to your situation. Anyway, back to what's coming next, because the COT data is just one piece of a much larger puzzle. Let's talk about what's happening with central banks, because this is where things get really interesting. Central banks bought over 1,000 tons of gold in 2023, the highest level since 1950. And in 2024, they're on pace to exceed that. China alone has been adding to its reserves every single month for the last 18 months. Poland just announced they're increasing their gold reserves by another 100 tons. Singapore, India, Turkey, they're all accumulating. Why does this matter? Because central banks don't buy gold to make a profit. They buy gold because they're worried about the stability of the financial system. They're worried about the dollar. They're worried about inflation. They're worried about geopolitical risk. And when central banks are worried, you should be worried. The COT report is showing us that commercial traders are positioning the same way central banks are, and that's not a coincidence. They're all seeing the same thing. Let me paint you a picture of what I think is about to happen. We're currently in a consolidation phase. Gold hit a new all-time high, pulled back slightly, and now it's building energy for the next leg up. The COT data tells us the foundation is set. The commercials are positioned for higher prices, the speculators are underweight, and physical demand is overwhelming supply. All we need is a catalyst, and there are about a dozen potential catalysts on the horizon. It could be another banking crisis. Remember what happened with Silicon Valley Bank and Credit Suisse last year? Gold spiked $200 in a matter of days. It could be a geopolitical event, an escalation in the Middle East, or a crisis with China and Taiwan. It could be an inflation shock, where the Fed realizes they can't keep rates high without breaking something, and they're forced to pivot back to easing. It could be a dollar crisis, where foreign holders of U.S. debt start dumping treasuries and buying gold. Any one of these events could be the match that lights the fuse. And here's the thing about gold. Once it starts moving, it feeds on itself. As the price rises, more speculators pile in. As speculators pile in, the price rises faster. As the price rises faster, mainstream media starts covering it. As mainstream media covers it, retail investors who've been sitting on the sidelines suddenly want in. And before you know it, you have a full-blown mania. We saw this in 2011. We saw it in 1980. And we're going to see it again. The difference this time is the scale. In 1980, gold went from 500 to 850, a 70% gain. But gold was coming from a much lower base. Today, if gold goes up 70% from current levels, we're talking about $4,400 an ounce. And I don't think that's crazy at all. In fact, I think that's conservative. If we adjust the 1980 high for real inflation, not the fake CPI numbers the government puts out, but real inflation, based on the methodology they used back then, gold should be trading at over $5,000 today, just to match its previous peak. Let me tell you about a conversation I had with a fund manager last month. This is someone who manages over $2 billion, someone who's been in the markets for 30 years. He told me he's never seen a setup like this in his entire career. He said the COT data, combined with central bank buying, combined with the geopolitical situation, combined with the debt crisis, it's all pointing in the same direction. He said his fund is overweight gold for the first time ever, and he's telling his clients to expect gold to be the best performing asset class over the next 3 to 5 years. This is not some gold bug talking. This is a mainstream institutional investor who normally wouldn't touch gold with a 10-foot pole. But even he can't ignore what the data is telling him. And if institutional investors start allocating even a small percentage of their portfolios to gold, we're talking about hundreds of billions of dollars of buying pressure. The COT report is showing us this is already starting to happen. Now let's talk about the technical picture, because this is where the COT data really shines. When you combine positioning data with technical analysis, you get a much clearer picture of where the market is headed. Gold is currently trading just above its $2,600 breakout level. It's tested this level multiple times and held. That's a sign of strength. The next major resistance level is at 2,800, and once we break through that, there's virtually nothing stopping gold from running to 3,000. The COT data tells us we have the fuel for that move. The commercials are positioned for it. The speculators have room to add, and the physical market is tight. All the pieces are in place. And here's what's really interesting. The gold mining stocks haven't even started to move yet. The GDX, which is the major gold miners ETF, is still trading below its 2020 highs, even though gold is at all-time highs. That's a massive disconnect, and it tells me the mining stocks are about to play catch-up in a big way. When gold really gets going, the miners typically outperform by a factor of 3 to 1. So if gold goes up 30%, the miners go up 90%. And if gold goes up 50%, the miners can double or triple. The COT data for the mining stocks shows a similar setup to gold itself, with commercials covering shorts and speculators underweight. This is a sector that's been beaten down for years and is now coiled like a spring. I want to address something that I know is on a lot of people's minds, and that's the question of manipulation. For years, gold investors have complained that the market is rigged, that the big banks suppress the price through naked short selling and spoofing. And you know what? They're right. The banks have been caught doing this multiple times. JP Morgan paid almost $1 billion in fines for manipulating the gold market. But here's the thing. Even the manipulators can't fight the fundamentals forever. The COT report is actually showing us that the manipulation is ending. When commercials cover their shorts, they're essentially giving up on price suppression. They're admitting that the market is too strong to fight. And that's exactly what we're seeing now. The banks that spent years keeping gold under $2,000 have thrown in the towel. They're no longer willing to stand in front of this freight train. And when the manipulators step aside, that's when you get the really big moves. Think about what happened in 2008 during the financial crisis. Gold was trading around $800, and the banks were heavily short. Then Lehman Brothers collapsed, the financial system nearly imploded, and suddenly those short positions became incredibly dangerous. The banks had to cover, and gold shot up to $1,900 over the next 3 years. The COT report captured that entire move. If you'd been watching the data, you would have seen the commercials covering their shorts in late 2008 and early 2009, right at the bottom. That was your signal to buy. We're seeing the same thing now, except the fundamentals are even more bullish. In 2008, the national debt was $10 trillion. Today, it's $35 trillion. In 2008, the Fed's balance sheet was under $1 trillion. Today, it's over $8 trillion. In 2008, central banks were net sellers of gold. Today, they're the biggest buyers. Every single metric that matters for gold is more bullish now than it was then, and the COT report is confirming it. Let me tell you what I think happens over the next 12 months. I think gold breaks through $2,800 by the end of this quarter. I think it hits $3,000 by mid-2025. And I think it's trading north of $3,500 by this time next year. That's a 35% gain from current levels, and it's based on the COT data, the technical picture, the fundamental backdrop, and the historical precedent. Could I be wrong? Of course. But the risk-reward here is so skewed to the upside that even if I'm only half right, you're still looking at significant gains. And here's the beautiful thing about gold. It's not just about making money. It's about preserving wealth. If the stock market crashes, gold goes up. If inflation spikes, gold goes up. If there's a geopolitical crisis, gold goes up. If the banking system has problems, gold goes up. It's the ultimate insurance policy, except, unlike insurance, it actually appreciates in value over time. The COT report is telling us we're at a point where that appreciation is about to accelerate dramatically. I want to leave you with this thought. The Commitment of Traders report is one of the most powerful tools available to investors, but most people ignore it because it's complicated and boring. They'd rather listen to talking heads on TV or follow the latest hot stock tip. But the COT data doesn't lie. It shows you exactly what the smart money is doing. And right now, the smart money is positioning for a massive move higher in gold. The question is, are you going to pay attention? Or are you going to be one of the people who looks back 6 months from now and says, I should have seen that coming? The signal is clear. The setup is perfect. The fundamentals are overwhelming. And the COT report just flashed the most bullish signal we've seen in years. What you do with that information is up to you. But I can tell you this. The people who understand what's happening right now are going to look back on this moment as one of the greatest opportunities of their investing lives. Don't let it pass you by.